What is going on, guys? Nick here, back with another video. This week I decided I would take a look at McDonald's stock and if they might be worth buying. If you've never looked into their business before, it is surprisingly way different than you would expect. When I initially looked at the revenue and net income statement, I was pretty concerned. But let me explain their business model and what's going on with McDonald's first so you can see what's really happening here. In 2014, McDonald's CEO Donald Thompson announced he was stepping down a few days after the company announced a weakening outlook. Customer traffic was declining, and even worse, sales at well-established restaurants were also declining. This was a terrible sign. After Thompson's departure, Steve Easterbrook took over. He was previously in charge of the UK and European business. Now, Easterbrook started with a big change that most of us probably remember: breakfast all day. They also made some other menu changes, like rolling out the Pick 2 for 2 to replace the dollar menu. Easterbrook made another big announcement that most of the public probably didn't notice. That was a new long-term goal to have 95% of McDonald's restaurants owned by franchisees. At the time, 81% of McDonald's stores were run by franchisees. They planned over time to continue to open new locations and sell some of their corporate stores to franchisees. They've done a very good job executing this so far. Right now, 93% of their stores are run by franchisees. Now, if you don't know how franchising works, McDonald's receives applications from individuals who want to run their own McDonald's restaurant. McDonald's then goes through a selection process to decide who will get to operate a franchise location. They're looking for people who will be active in the business operations and not just passive investors. At the same time, McDonald's will select land that meets specific criteria that will have enough traffic to support a restaurant. Then McDonald's either buys the land or secures a long-term lease and then puts a building on it. After being selected, franchisees will go through a 12 to 18-month part-time training course, all before being allowed to purchase a restaurant. The franchisee will then pay for the equipment, the signs, the seating, and the decor. The franchisee typically will sign a 20-year term, making an upfront payment and then paying rent and royalties to McDonald's. This creates a very stable income for McDonald's. McDonald's now has a qualified business owner with a vested interest in the success of the restaurant, and somebody who should have a good understanding of the location's issues and specific market conditions. The reason why McDonald's is moving towards this is for two big reasons. The first is to help reduce corporate costs. Franchisee restaurants require less investment and staffing from corporate. The franchisee selection process is to find people who will run their businesses well. Franchisees are also responsible for reinvesting into the business on their own. Now, the second major benefit to the franchise model is creating a stable, predictable source of income for long time periods. The franchisee generally signs 20-year deals to operate a location. While they are focused on improving the global sales between the corporate-owned stores and the franchise locations, the most important priority is to make sure the location can pay the rent and the royalty fees. In 2019, Steve Easterbrook, the CEO who made the changes to the business, was forced out by the board of directors. It was initially discovered that Easterbrook violated company policy by having a consensual romantic relationship with another employee. It's since gotten much uglier after McDonald's filed a lawsuit claiming that Easterbrook lied, concealed evidence, and committed fraud. They're alleging that he carried on a relationship with 3 different subordinate employees and awarded a large chunk of McDonald's shares to one of them in the year before he was fired. The new CEO, Chris Kempczynski, took over in August of 2019. Kempczynski was actually brought to McDonald's by Easterbrook from Kraft in 2015. They had worked closely planning things like the all-day breakfast, the digital menus, and the food delivery service deals. Now, taking over as CEO of a major restaurant business when restaurants are regularly having to reduce capacity and completely close indoor dining is a very tough spot. Kempczynski's plans are to focus on 3 different areas: drive-through, digital ordering, and delivery. They plan to invest in building a better mobile app, a loyalty program, and new menu items such as chicken sandwiches. So now that we have an understanding of how McDonald's makes money, let's take a look at how they're performing. But before I do that, if you found this video helpful so far, please take a second to scroll down and hit the like button. I put a lot of effort into making sure that these videos give you enough information to make an informed decision before you buy. So if you could pay me back with a quick thumbs up, I would really appreciate it. So here's the revenue, operating income, and net income chart for McDonald's. We can see in the Don Thompson era, which was from 2012 to 2015, revenue was starting to decline, and operating income and net income were totally flat. 2015 is where Steve Easterbrook took over. We can see that while revenue continued to decline, operating income and net income did start to grow during this time period. 2020 has definitely taken a hit on the business. We can see that they dropped about $1 billion in net income due to restaurant closures and reduced seating capacity. But all things being considered, only dropping $1 billion in net income seems pretty impressive to me and says a lot about the strength of their business. Now let's take a look at the last 8 quarters individually. We can see how quarter 1 and quarter 2 took a big hit, but the most recent quarter 3 was actually the most profitable of all 8 quarters. I expect that with rising cases, hospitalizations, and restrictions, that quarter 4 may look a little bit more like quarter 1 and 2. However, the analysts are projecting quarter 4 to earn $5.3 billion in revenue and about $1.3 billion in net income, so we'll see how these numbers hold up. If we look at the segment performance, we can see some really big differences between the revenue and operating income from each segment. It's pretty clear how much more gross profit they're left with when comparing company-operated restaurants versus franchisee-operated restaurants. This comparison explains why revenue was declining, but net income was still slightly increasing. So let's take a look at the valuation for McDonald's. Looking at the growth rate of their gross profit and net income, I think it's most important to only really consider the Easterbrook and Kempczynski years, so from 2015 on. On this chart, the years at the bottom of the page is the percentage growth from the previous year. So 2016 is the first year we should pay attention to. I think that 5% seems like a pretty reasonable number for McDonald's. But if you want to try this with a different number, check the link in the description for the Google Sheet where you can calculate this on your own. 5% growth comes out to a fair PE value of 15. With a trailing earnings per share of $6.56, this comes out to a valuation of $98 per share. If we look forward to the 2021 analyst projections, they're currently forecasted to earn $8.34. This brings the valuation up to $125 per share. So while this valuation comes out to double the share price, I do think there's something here that helps us reconsider. McDonald's is what you call a dividend aristocrat, which is defined as a company that has consistently paid and increased its dividend for 25 years. I think that this is actually what's keeping the share price up. When companies pay dividends, they're literally taking their profits and giving them to shareholders. It's important to pay attention to the earnings per share to dividend ratio. This is called the payout ratio. If a company is paying too much of their earnings per share as a dividend, they may have to cut back. Usually when there's a high level of confidence that dividend payouts will continue, you have to pay a higher amount per share. Now this will change based off of interest rates, but right now that number seems to be about 2.5% to 3%. We can see that McDonald's dividend payments have pretty much continued with their earnings per share growth. We see a dip in 2014 and 2015 when they were having issues with sales, and also this year with the impacts of COVID, but for the most part, very consistent. McDonald's pays its dividend once a quarter, and most recently that was $1.29 per share. This is 2.3% annual dividend yield. Looking at the dividend payout chart, we can see how very consistently they've continued to raise their payments. Now the last thing to look at is the balance sheet. They reported most recently $50 billion in assets and $59 billion in liabilities. This leaves us with negative $8 billion in equity. Their total debt is $51 billion, so this is a pretty bad balance sheet. But because the business operations are so profitable and will continue to provide stable, consistent, long-term payments, I don't think this is an issue that would keep me from buying shares. Personally, I would really like to see them pay off some of this debt though. So I think McDonald's shares are a good buy depending on what you're looking for exactly. If you really like steady growth with a decent dividend payment, this is a great company to own. It's going to consistently pay you that 2% per year and grow that payment by about 4 to 12%. That dividend growth will continue to drive the share price up over time. I think they've also positioned themselves well to have a steady income stream going forward, which is perfect for a dividend company. Now, I don't own any shares of McDonald's and I'm not planning to buy any soon. That's only because I'm not looking to add any dividend stocks to my portfolio right now. But if I was in a different situation closer to retirement, I would definitely consider adding McDonald's to my portfolio. Now, if you found this video helpful, don't forget to subscribe so you know when I upload a new video. And as always, thanks for watching.